Welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We got 1 hour to go into the market close, and we are taking a look at a reversal, a Friday flipperoo in the markets here, because we had been seeing the selling pressure continuing. And then we heard from Fed Chair Jay Powell, and his comments seemed to catalyze the market higher, up by about 175 points in the Dow, 0.4%. The S&P up a similar amount, and the Nasdaq up a little bit more, 0.5%. Some perhaps much needed relief for the bulls in this market after what has been a very volatile week.
Yeah, we had the jobs report today. It was a bit weaker than expected, but I think generally, Julie, people thought, like, they read through that report and thought no big surprises. It kind of dovetailed with that narrative we've heard. Cooling, not crashing, broadly stable. I mean, there's concerns. Of course, we have concerns. We're investors, so tariff uncertainty and federal government layoffs. But to your point, I think investors were also interested. Well, what does the Fed think about all this? What did they make of this report? And I do think it was interesting. Jay Powell talking the economy. The economy is fine, he said. Those were his words. It's fine.
Yes, it seems like that they have some wiggle room to indeed cut if and when they will need to. And there's another big reason that February jobs report didn't hit the market more dramatically, and that's because a lot of investors are looking past it and looking to the next jobs report to see if some of those things that you mentioned, whether it's the federal government job cuts, whether it's the tariffs, whether they will start to filter through to the economy more in the next month. So all of that filtering through to stocks, and now seeing a gain after we heard from Powell. The 10-year yield, which had been trending lower, now a little bit higher, not a huge move, but at 4.32%. And let's also take a look at what we saw from the sectors here today. Energy, which has been a loser this week, rebounding today. We still have financials in the red, though, and that's been one of the groups that seems to reflect some of this concern about the economy.
We didn't even talk about crypto yet. All things crypto.
You want to go crypto?
Well,
we
I
can
thought
go crypto.
it was interesting in that we get the Bitcoin reserve, which of course President Trump on the campaign trail, he made that promise, he makes good on that pledge. They weren't really that wowed, which I guess, Julie, is that crypto fans be like, well, I got the reserve, but you didn't tell me you were going to be buying tokens. I didn't get that. Maybe that's
we're just transferring the tokens that the government has seized into.
Was that a bit of a letdown?
It seems to have been a letdown. So if we look at Bitcoin year to date here, and we definitely saw at the beginning of the year that climb right above 100,000, and then the come down, maybe a sell the news kind of situation, who knows? But as we speak, the White House is preparing to hold its crypto summit today with a handful of leaders in that industry. We'll see what kind of headlines we get out of that, if anything different.
Who knows what could happen?
Yes.
For more on the latest market moves, let's welcome in now Phil Orlando. He is Federated Hermes Chief Equity Strategist. Phil, it is great to see you. We're wrapping up this roller coaster of a week, Phil. I got growth worries, I got tariff threats, I got a trade war, Phil. On the other hand, as Julie was just mentioning, Phil, I had Fed Chief Jay Powell today. He was talking today. He says, you know what? Economy is fine, Phil. That's what he said. It's fine. Those were his words. What do you make of it all, Phil? What are you telling your clients as we head into the weekend here?
Well, first of all, Josh and Julie, thank you very much for having me back this afternoon. We have been on a roller coaster. I think that's a great analogy. Benchmark 10-year Treasury yields over the last couple of weeks have gone from 4.8% to 4.1% and are now back to 4.3%. And the S&P 500 has declined by 8% in the last 2 weeks. So it's not for the faint of heart. Now, getting over to Powell, I was actually watching him while I was having my lunch break today, and he was very calm. He didn't seem panicked at all. Everything's fine. We're not in a rush to cut interest rates. If he was truly concerned about a collapse in the labor market or some deleterious impact on the economy due to fiscal policy, tariffs, immigration, whatever, the Fed might be more inclined to cut interest rates aggressively to try to provide some support for the economy. But he didn't give us any inclination that the Fed is thinking that way at all. Now, we've got an FOMC meeting coming up on March 18th and 19th. We've got an SEP report coming out of that, the summary of economic projections. But the Fed, because Powell was calm today, I think that gave investors some confidence that the world is not coming to an end.
Well, boy, if you see a panicked Jay Powell, that would be something indeed, Phil, and something that nobody, I think, wants to see, who is a market participant, certainly. But there is a long distance between panicked Jay Powell and buy in the market, right? And so I'm curious where you are on that continuum. I believe at one point you had a 7,500 target for the S&P 500 for year end, and I'm curious if you're still there, considering maybe not panic, but considering at the very least ripples that we have seen in some of the data.
So, Julie, we still have a 7,500 target on the S&P. That's at year-end 26. Our target for the end of this year was 7,000. But when you and I met, I guess about 3 or 4 weeks ago, I did tell you that we felt that near term the stock market was probably ahead of itself, in part because of the Mag 7 outperformance, and that we were hoping that we would see a correction that would take the market back down to about the 200-day moving average level, roughly about the 5,700 level. And ironically that you have me on today, we hit that level earlier this morning. So the 8% correction that we've seen over the last couple of weeks is exactly what we're hoping for. Now let's see how the dust settles and whether or not that's an opportunity to begin to put some more money to work.
And Phil, just to double tap on that. So despite, listen, growth wars bubbling up, trade war, tariff headlines, that has not caused you, Phil, to tweak your EPS growth estimates for 25?
Not at all. This is exactly what we've been looking for. The volatility early in the Trump administration as he upsets the apple cart. But as we're looking out over the next 12, 18, 24 months, the decline in energy prices, deregulation, lower inflation, we felt that all of that was going to result in slower economic growth at the end of last year through the first part of this year. But then as that gets embedded in the economy, we were going to see a reacceleration of economic growth into the 26 and 27 timeframe. It's on that basis that we've got a 7,000 forecast at the end of this year and 7,500 at the end of calendar 26. There's nothing that's happened over the last, 6 weeks or so that has shaken us from that opinion.
I guess I would ask, why not, Phil? I mean, we've had a lot of companies on their conference calls address concerns about tariffs, but not just concerns about tariffs. In some cases, and I'm talking specifically about some of the consumer-facing companies, they've expressed concerns about consumer demand here. We've seen it show up in some of the surveys, certainly. So what do you think is going to happen between now and the end of this year or going into next year that's going to change that?
Well, none of this was unexpected. That a new sheriff comes into town.
Well, actually, Phil, I would push back on that a little bit because there was really this euphoric feeling in the market after the election. And it didn't feel like people expected what we've seen thus far this year in terms of the velocity and magnitude of actions and the market reaction. I mean, if everybody had seen this coming, the market wouldn't have done what it did, right?
Fair point. From the bottom of the market last August into the market peak recently, the S&P 500 was up 20%, 20%. In a matter of a few months. So you're quite right. There was a lot of euphoria built into that. But again, our job at Federated Hermes is to try to take a more unbiased view of what we think will happen or should happen. And our view is that there would be some volatility and some concern once we actually started to see, the sausage making play out in terms of what the impact was going to be on economic growth and inflation and corporate earnings and employment and all the things that seem to be rattling the market now. So I agree with you, Julie, that there was a tremendous amount of euphoria, but we felt that the market was a little bit ahead of itself. There would be a soft patch here, and then that soft patch will reverse itself, we think, into a reacceleration of growth and better stock market performance as we get into the back end of this year and into calendar 26.
Well, we'll catch up all along the way, I'm sure, Phil. Thank you so much.
Absolutely. Thank you. Have a great weekend.
You too. We're just getting started here on Market Domination. Coming up, Morgan Stanley, the latest firm to lower its 2025 economic growth forecast for the U.S. We'll discuss those latest moves on the other side. Plus, shares of Hewlett-Packard Enterprise sliding after earnings. We'll hear from the company's CEO, Antonio Neri, later in the hour. Stick around, much more Market Domination still to come.
Morgan Stanley, the latest firm to lower its 2025 economic growth forecast for the U.S. Concerns on tariffs and weak economic data bringing down optimism. And Yahoo Finance's Josh Schaefer joins us now with more. Josh.
Yeah, so we've been talking a lot about sort of this shifting growth story in the U.S., right, with the data that we've seen to start this year. And what you're seeing now is economists put that data back into their models, maybe account for a little bit of tariffs, and what is coming out is weaker growth forecasts, right? So you mentioned Morgan Stanley, Josh. Morgan Stanley now sees a real growth forecast for the end of 2025 at 1.5%. That's down from 1.9%. And then you're looking at Goldman Sachs also out today, lowering their forecast for the end of this year down to 1.7%. From a prior reading of 2.2%. This, of course, follows what we've been talking about for Q1 data, right? So we've been talking a lot about the Atlanta Fed GDP Now model. That's been getting a lot of buzz. The interesting part of that data says always that it just follows data that comes out throughout the quarter, right? So it's following indicators as they come out. If the quarter sort of ended today in some ways, that's where we're tracking. Normally that data will probably come back up is what economists are projecting. That's that shift that you're looking at.
You and I were talking off camera about this earlier, and you said you were a little annoyed about the Atlanta GDP Fed Now. Is that fair to say?
Yeah, because it's obvious the January data was bad. So of course,
so it goes way down, and then it'll come back.
And then it likely comes back up, right? Yes. And I think I'm a little bit annoyed about the conversation overall because I brought another chart with us from FactSet, and it's the amount of companies talking about a recession, and that's at a 5-year low on earnings calls. And so I feel like we've been talking a little bit, and you hear some people talk about a recession trade. This to me is more of a slowdown trade.
Right.
We're not talking about an economic recession here. That is not really where most economists are sitting. It's repositioning for maybe the U.S. economy doesn't outperform the rest of the world again. Maybe the U.S. economy doesn't surprise to the upside, economic growth surprise to the upside for the first time in 3 years. Right. So it's a little bit of a reset of growth expectations. But even the numbers that I read off the top there, a little bit below 2%. Yes, you're below your 2% moniker that we always talk about, but it's not zero. Right? And so I think that's an important part of this conversation.
Well, we keep talking about the word stagflation, right? And implicit in the idea of stagflation is not that there's a recession. Right. It's that you have stagnant growth. It either slows or just kind of goes along, and we don't see significant expansion at the same time that you see inflation remain high.
Right, and inflation would remain sort of sticky, right? And so that seems to be what's becoming a little bit more of the consensus call right now. And of course, what we should also bring up, this is including tariffs from a lot of these forecasts, right? It's including that we actually eventually get full 25% tariffs on Mexico and Canada for some level of time. And to me, that also feels very up in the air, right? So it's this moving target of the market itself. The stock market is trying to price in and discount what tariffs mean, but so too are economists and forecasters, and it's just becoming a challenging thing to pin down. I think a lot of forecasters that we speak with hadn't wanted to necessarily move their forecast quite yet, because what are we getting from tariffs? Right. And so really what it is, it's a best guess based on what the administration has said today, and that could also move next week. It could move this weekend.
It could move later today.
Right, and so it's very big moving target, I think, especially when we start talking about the entire year and what the economy is going to look like by the time we get to the end of this year. It's hard to know what we're going to get by the end of next week at this point.
Yeah. Josh, thank you. And we're going to talk to another of those forecasters right now. The February jobs report pointing to a softening labor market. Job gains in the U.S. increasing slightly as the unemployment rate rises to 4.1%. The report coming during a week of volatile market action thanks to President Trump's tariff policies. Here to come through the latest economic landscape, Jefferies chief U.S. economist Thomas Simons. Tom, it's always great to see you.
Likewise.
Boy, you got a tough job right now, as we were just discussing, in terms of trying to figure out what the economic landscape is going to look like. Tariffs, obviously a big part of that, but we don't know what's going to happen with tariffs. So
exactly.
I believe you did just reduce your forecast as well. So I guess, first of all, talk us through your thinking on that.
Sure. Yeah, I'd love to. I did just release a new updated version of my economic outlook. I realized as I was going through it, I hadn't updated it since before Inauguration Day. And that really does sort of reflect this notion that, we kind of have an idea of how things are going to be going, but the specifics are very hard to nail down. That hasn't gotten any easier over the last 8 weeks or so, right? I do think that as we get some more of this data, we do see that the sort of core activity going on in the economy, most, sectors related to consumer spending and that sort of thing, everything seems to be more or less okay. I think that's more or less exactly what Powell said earlier today as well. There are disruptions. We did see that big jump in imports in January that followed what looked like a big jump in imports in December. Of course, January more or less dwarfed it. That's going to cause some disruptions to the data. It's going to cause, it's a negative for GDP math. But imported goods have to go somewhere. There are offsets with increases in inventories and that sort of thing. And there's nothing really broken with the U.S. economy as it sits. And as a consequence, we have to mark down growth expectations for the first half, again, just based on the sort of, GDP math. But there's no reason to think that trend growth has shifted lower or that we won't see some rebound in the second half of the year or perhaps 2026 when policy starts to sort itself out a little bit more.
Thomas, we did get that jobs report today, a bit weaker than expected, but I think most looked through that report and said, no big surprise there. I'm just curious what you made of that report, Thomas, and importantly, just how you see that labor market evolving over 2025.
Yes, I was actually pretty concerned coming into this number. I would definitely count myself amongst those who had, lower forecasts and was worried that we were going to start to see the first, real negative impact of policy uncertainty on the economy. But the numbers came through fine. The job growth, I don't want to get too technical here, but, job growth, when you take out the seasonal adjustments and you look at February for the last 3 or 4 years, typically we see over 1 million jobs created in February. A lot of them are at the state and local government level. A lot of them are in education and healthcare. And those are definitely sectors that are very uncertain right now about continuing government funding, driving programs that need employment and whatnot. So I had thought maybe, if we don't get that job growth from those sectors, where else are we going to get it from, right? I thought there was a lot of downside risk. But it turned out that we did still see solid healthcare hiring, some good hiring in construction and manufacturing. And I do think there are some warning signs. We did see the ADP data earlier this week showed healthcare hiring had fallen off a little bit. So it'll take some time for revisions and things like that to come through to sort of circle the square between those two numbers. And there will be more uncertainty in the months ahead. But at least for now, it looks like the worst is not upon us.
Tom, I also wanted to ask you about the so-called U6 rate, right, which is referred to as quote-unquote underemployment. It's people who are employed part-time or people maybe who have stopped looking for jobs because they weren't able to find one. That actually ticked up to 8%, which is the highest. Yeah. I saw a lot of economists referring to that today as a cycle high, the highest since 2021. What does that mean? What does that tell you?
Yeah, so the U6, it's funny. I don't remember hearing people talk about the U6 since, way back past, just past the financial crisis. That was a popular metric where everybody was trying to say that the unemployment rate, as stated in the headline, was, significantly underrepresenting how bad economic conditions were, in the labor market. So now I think, it is important that it went up 0.5% in a month. I think because it includes more people that are unemployed, by definition, it has more volatility. So, the range month to month can be relatively high. But if you break down, U3 versus U4 versus U5 versus U6, and you sort of isolate what the difference is between them, it's people who are working part-time for so-called economic reasons that jumped up significantly. It was something like 400,000 people reported that was the case. Now, what does that mean? That means that you are either on temporary layoff or you worked fewer hours than your full-time job for some sort of non-business reason. And I think that really, describes a lot of the uncertainty that we were just talking about with hiring. I think that's also going to apply to, contractors that are not sure if they should continue working on something. And, maybe they're telling people like, take the week off. We're on pause here for a minute, that sort of thing. So I do think it reflects policy uncertainty more than some sort of fundamental deterioration in the labor market. The measures of people who are, marginally attached, discouraged workers, that sort of thing, those didn't budge too much. So I'm going to throw this one up to more on the uncertainty hook.
Tom, it's kind of another question for you. I'm interested to get your take as an economist. When you think about Trump's broader economic vision here, and we've been talking about it all week, of course, on this show, Tom, with different economists and strategists, what he seems to think, and clearly his administration believes, is yes, we're going to impose tariffs. And he'll say, yes, there could be some short-term pain. But they clearly believe, Thomas, that is going to result in these long-term benefits, long-term gains in jobs and manufacturing and growth and investment. As an economist, is that how you see it?
So my views are evolving on this, I'll say. When I first heard about tariffs, and certainly in the first administration, I mean, the tariffs, in my opinion, were not very good, well-crafted policy in the first administration. And the trade deals that they were, aimed at generating, of course, we'll never know what it was going to be like without COVID, but they fell apart rather quickly. This time around, it appears to be very, very different. And the orthodox school of economics, as it looks at tariffs and thinks about them as a 19th century, financing policy for government spending, yeah, it doesn't work very well, right? And the risks are clearly skewed towards that burden being borne by consumers via higher prices. But this time around, there is an overarching umbrella plan that they are trying to execute on that goes towards, really restructuring the, responsibility, the burden of financing global trade. Same thing with financing global defense. And their assumptions are that they can do enough rejiggering of this policy in order to offset the risks, adjust the currency on a global basis, share the burden of that defense spending and whatnot with others. We certainly see that with Europe now, and create a system that they judge as more fair, whatever you want to define that as, that's up to you. But, it's clear to me that they have full buy-in, both from Trump, Scott Bessent at Treasury, Howard Lutnick, and other policy advisors that they have, working behind the scenes. Everybody is all ahead full on this plan. And that's what sort of ties everything together and makes it make sense why we're going after Canada and Mexico, because the tariff plan doesn't work unless it goes across the board and you don't have substitution channels where goods can move and avoid those types of tariffs.
Tom, I could talk about this all day, but we got to go. Thank you so much. It's great to see you as always.
Thank you.
Time now for some of today's trending tickers. Taking a look at shares of VF Corp to start the company's investor day. Disappointing Wall Street. The apparel and footwear company refraining from providing new updates to its financial forecast. The stock actually fell yesterday as that meeting was happening, and it continues to fall today as analysts are weighing in on this. VF, by the way, the parent company of Vans, North Face, Timberland, consumer-facing brands like that. One of the analysts weighing in, Needham's Tom Nikic, who said management not yet comfortable for providing revenue targets. He says turnarounds are rarely linear and there's still a lot of work to be done.
Yeah, Truist weighing in as well. They have a hold on this one, saying they came away incrementally bullish on the structural shifts that the new management team is undertaking, progress they're making, but continue to view any potential turnaround as a long and uncertain process. They thought maybe investors were hoping for a bit more optimistic update on the revenue outlook. Their target's 24. Average on the street, by the way, looks like about 26.
Yes, and the shares are up still over the past year, about 17%.
Meanwhile, Boeing shares under pressure as more safety issues arise. A Boeing employee reportedly raised an issue with the 787 Dreamliner's quality checks. The company also facing technical obstacles to delivering Trump a new Air Force One. So this was a Bloomberg story about how President Trump is kind of waiting for Boeing to deliver a new Air Force One jet. The project is over $2.7 billion over budget now. It's facing all these what are described as technical obstacles, Julie. So flaws in cockpit and passenger windows, cracked fuselage structures, excessive noise. Current schedule calls for delivery of the first plane in September 26, second in February 27.
Well, and this comes on the heels of a sort of internal message that was obtained by Bloomberg News from Kelly Ortberg, the CEO, talking about that tariffs were going to take a toll on the company. Now, this is not a surprise. It's, it would make sense. Nonetheless, he said that there's potential for costs to go higher as a result of this, and he talked about it being very expensive. So that's something else that investors are paying attention to here. I mean, we were just talking about VF Corp as a turnaround story. I mean, obviously Boeing, what could be more of a turnaround story that investors have been waiting for than Boeing, and it's one that hasn't really been materialized.
By the way, Trump waiting for this plane,
yes,
reportedly saying they can never finish this damn thing. Doesn't sound happy.
You don't
Not
want
happy.
that.
Not happy, Trump. Coming up, Tesla shares lower again today as the bulls behind the EV giant are being tested. We're going to speak to one of them on the other side of today's call of the day. Stick around. Much more market domination still to come.
One of the most active tickers on the Yahoo Finance platform is HPE. Tough quarter. Shares really under pressure after the company came out with disappointing earnings and a tough outlook. Let's bring HPE CEO Antonio Neri in here, no stranger to our programming. Antonio, I know it's a tough day. Appreciate you hopping on here. Let's start with the market reaction. I think as some folks that I talked to, they were surprised by how the quarter came out. You know, as the quarter was trending along, what caught you by the surprise here?
Well, Brian, thank you for having me today. Obviously, it's a disappointing day, but I think you need to separate the story into two different parts. On the quarter side, we deliver on all our commitments. In fact, we had a terrific revenue growth of 17% year over year. And our non-GAAP EPS came right in line to the midpoint of the guidance that we provided last quarter. So from the financial metric perspective, that was in line. And the bookings in the quarter were very strong, up double digits year over year. The disappointment was on one specific metric, which was the server operating margins, which came below what the street had in their consensus. And that had to do with the fact that we find a couple of issues that we could have executed better, so it's on us and on me. And that was related to three things. One is aggressive discounting in the traditional x86 business. We see a very competitive market out there. Number two was the valuation of our inventory was not aligned to our pricing. And we found that end of the quarter, which is very disappointing to me. And so those what I call execution challenges. And then on the AI side, we had a higher than normal inventory to related parts like Hopper and so forth, because now the service providers and the model builders, which lead with time to market with the latest technologies, are moving to the latest generation. In fact, in Q1, we doubled the bookings sequentially in AI, but 70% of that was on the Blackwell side. So our guide, which was obviously, in my mind, the biggest disappointment, was all of that included, plus the tariffs. Because we announced 2 days after the tariffs came in place and obviously enacted, we felt that was prudent for us to put it all in the guide so that the street has a flagpole on where we're going to drive, and then also, obviously, the delay of the Juniper deal.
Antonio, you and I have talked a good bit, and this is the first time I think I've heard you talk about greater competitive activity, discounting or really heightened competitive activity in servers. To the layperson out there, did someone else that you compete with come out with a better product? Like, what's going on out there in the trenches, so to speak?
No, I argue that innovation is phenomenal because we had double digits year over year orders growth across all our businesses. In the server business, both traditional server and AI, in our networking business, in our Aruba business, and also in elements of a hybrid cloud where we saw that our storage business grew triple digits year over year on the booking side, and our GreenLake had the terrific quarter again with the AIR, the subscription part of the cloud, up 46% year over year. So from a product innovation perspective, no. But I think people are realizing that obviously to gain share in the market, you have to be way more competitive. And that's where I think, the aggressive stance took place.
When do you think the discounting will normalize?
Well, on the two issues I talked before about the cost alignment to the inventory and discounting, we already took aggressive actions, and we already see the benefits of that. But however, because of the size of the business and the fact that you have a backlog with a pricing that's lower than what we are pricing today, it will take 1 to 2 quarters to see the full benefits of that in our operating margins. But we expect to exit Q4 with a normal 10% or so operating margin in the server business. And then on the AI business, it takes time to realign the working capital. but we feel that will take place over the next 3 quarters, and and then obviously we're going to make the transition to the latest GPUs.
And you're taking tough actions here, Antonio, coming out with 5% workforce reduction. Is this a first component, or we're only doing 5% here? We're going to have these cost savings, and then we're going to hope the business gets better.
Well, my plan was, Brian, that we were ready to announce the entire set of synergies, inclusive of the Juniper deal. And remember that Juniper deal, we committed to at least $450 million in annual gross savings for our shareholders. So if you take the two combined, you can see it was close to $800 million. But we decided to go ahead and start with the HPE standalone, because we see incremental cost opportunities across our company, also by leveraging the latest technologies with AI. And then once the Juniper deal closes, we will execute the second part of this, and therefore the plan was already kind of in place.
What's the latest on the Juniper deal? My understanding is this is going to, a trial? What's the next component?
Yeah, first of all, we are disappointed that the DOJ decided to file a lawsuit to try to stop the Juniper transaction. We believe this transaction is pro-competitive. It will change the dynamics of the networking market. In addition to significantly advance the U.S. national security agenda outside the United States, because the combination of Juniper and HPE will provide a very strong alternative to vendors like Huawei. However, the suit has been filed, and now we are in litigation, and the judge has been selected, and the trial date is set for July 9th. And we expect, therefore, during the month of July to complete the trial, and hopefully shortly after that, the judge will issue his ruling.
I think the thinking coming into the Trump administration, Antonio, was this is going to be a friendlier backdrop to getting deals or transformational deals like this done. I mean, what are these just Biden leftovers here that don't want to see big deals getting done?
I believe so for the most part, but obviously we need to wait for the new appointee, Gals later, to be confirmed. Mm-hmm. And then I'm sure she will take a look at all the cases. Remember that we are not a big tech company. We are what I call a core tech company. What we do for the United States is to power the core infrastructure, including the Department of Defense and the Department of Energy. Many of the systems we provide, and you and I have spoken about it in the past, in the Department of Energy are used to do simulation and modeling now using AI. Many of those is to do seismic research. Obviously, that will advance the agenda of being more energy independent going forward. And in the Department of Defense, obviously, we power the key missions of military and others. So when that comes to play, I hope that will be a consideration. But then from a pure antitrust perspective, just by applying the antitrust law, basically it says there is no case here, because the combination of these two companies still smaller than the big one, and is still pro-competitive, where there is at least 8 vendors here in the United States the customer had the choice to work with.
All right, well, I still appreciate you coming on, Antonio. I know it was mixed quarter, tough on the outlook. Not what you normally come on here and discuss and break down for us. Appreciate the time nonetheless. Antonio Neri, HPE CEO. We'll talk to you soon.
Thank you, Brian.
All right, Josh and Julie, back to you.
TD Cowen initiating coverage of the U.S. auto sectors today, issuing buy ratings for General Motors and Tesla in particular. For more, let's welcome in Itay Michaeli, TD Cowen equity analyst. Thank you so much for being here. I thought your note was really interesting because you obviously looked at these companies specifically, but you also have this sort of overarching narrative. And one of the things that you say that you are looking for in your top picks right now is sort of defensive characteristics. So I guess I would ask, first of all, why? And what would you say are defensive characteristics right now?
Absolutely. Thanks for having me on. So, defensive franchises to us in auto are the rare few markets where many of the headwinds that we read about and look at in the automotive industry really don't apply to as meaningfully or even at all. One of the strongest end markets we think globally in automotive is the North America pickup truck market. We think it's a majority of GM's earnings and Ford's as well. And so these are markets that where, if you look at the multiples on these stocks that have been pricing in peak auto and peak margins for quite some time, these are markets that can still grow, they can flourish, and they also provide a base for these companies to then be able to invest in future growth in EV, AV, and software, while having these strong core franchises there in place. So it still is, just given all the complexity in global auto, new competition, many headwinds, we look for those few rare markets where we can still see healthy growth, healthy margins, and ultimately drive multiple expansion on earnings beats.
On Tesla, I want to get your take on this because we've had some analysts who cover that name. And part of the argument they've made, including some analysts this week on this show, is about Elon Musk and that he has become a problem. Too political, too much of a lightning rod. And their suggestion is he is, in fact, negatively impacting Tesla's fundamentals. What's your response to that?
Look, there's always going to be a list of bull and bear cases and upside and concerns with this stock. It's always going to be very highly debated. And there are some legitimate brand concerns right now, sales, market share pressure, competition. But ultimately, we always like to look at these stories from what's happening on the product side. And Tesla, is about to launch a significant new product. They're already launching the refreshed Model Y as we speak. And so typically when you have sentiment as poor as it is now, the stock down about 50% from the highs. We all know Q1 is expected to be a tough quarter. That's typically ahead of product catalyst, the time to actually take the other side of the view. Because there's still a lot of expansion in EV demand around the country and globally. We even think that Tesla has an opportunity to regain some share in some of the top EV counties where the company has lost some market share. And certainly as they make progress on full self-driving, whether that's eyes on or eyes off, of course, any incremental feature of value add can also accrue to the company's market share and brand perception. So there are some near-term challenges. We don't dispute that at all. But ultimately, I think particularly once we get through Q1, there are significant and potentially consequential catalysts for the story over the next 12 to 24 months we want to be there for in the stock.
What's the potential, though, that even with new product, buyers won't show up?
Look, there's always a risk, right? Obviously, you want to make sure the products are attractive, well-priced, well-designed. You want to look at the design language of those vehicles.
Does some of it have nothing to do with the actual product, I guess is what I'm asking. If there is this sentiment issue that clearly is an issue with the existing product that's out there, I guess how much do you think that will be a problem even for the new product that has nothing to do with the product itself, no matter how good it is?
Sure. There are still many parts of the country, it's a good question, where EV demand is low, where Tesla's brand can still grow on existing and particularly new products. So ultimately, our call is that new product is going to be still the main driver going forward here, because there are many, many parts of the country where EV demand is still low, Tesla's share is still low, that can be unlocked over time. One important point to make is when you think about EV demand in the US is because we have a starting point of 2 vehicles per household, you could have this sort of theoretical upside scenario where more and more people kind of wake up and decide to have the best of both worlds, so to speak, in having one electric vehicle and one internal combustion vehicle. If that were to start to happen in succession in the US, EV demand can balloon and inflect to much, much greater highs than commonly expected. And of course, companies with capacity, product, and technology could lead the way. It's going to happen overnight. We don't think so, but certainly if you have product and you can unlock new markets, as we think Tesla has an opportunity to do with the next round of product, that does make for a more promising setup, particularly with sentiment where it is today.
Itai, thank you so much for your time and those picks. I appreciate it.
Thank you.
Let's take a listen now as President Trump hosts the first ever White House Digital Asset Summit.
During my first term, we worked out a deal to get the World Cup, and then because of lots of interesting things that happened, I ended up being president when it showed up. I was always disappointed. I wasn't going to make it. I was going to serve 8 straight. Instead, we did it the hard way, but maybe the more important way. So I will be with you as president, Johnny. So maybe you could just say a few words and show how beautiful the World Cup trophy is. Thank you. Yeah, sure, please. Yeah.
The famous key.
That's a great key.
You want to open it, President, or shall
Well, you go ahead.
I go ahead?
I trust you.
So this is the new trophy of a new competition. It's called the FIFA Club World Cup. The 32 best clubs in the world with the absolutely best players in the world. And for the first time in history, this competition.
Let's take a quick look at the markets here. We have been watching President Trump's crypto summit that he's holding at there at the White House. So a little bit of a diversion there to take a look at a World Cup trophy. But regardless, we've got U.S. markets that have turned higher, and this following some comments from Jay Powell, the Fed chair, of course, earlier today, talking about that the economy is fine, and that seeming to provide some reassurance, or at least a catalyst for markets to move higher into the weekend. All three major averages up in the neighborhood of 0.4 to 0.5%.
Session lows, Dow was down more than 400 actually.
Yes, so big swing today again.
All right, Netflix shares, they are under pressure again today. That company finished last year strong with 24 million subscriber gains in the second half of 24. But our next guest's new note on Netflix points to some troubling signs in 25. For more, we're bringing in Robert Fishman, senior analyst at MoffettNathanson's. Robert, always good to see you on the show. So Netflix subscriber growth goes out with a bang. You say here, Robert, they added 24 million subscribers over the last 6 months of 2024. What drove that, Robert, and what do you see ahead? How much room is left in subscriber growth ahead?
Yeah, thank you. So, I mean, clearly Netflix had an unbelievable 2024. When we look back at the success that they had from the subscriber growth that you mentioned, clearly there was a lot of different reasons driving that sub growth. They did crack down on the password sharing, which continued to be a much bigger benefit than we expected. They also very smartly introduced the advertising tier, and that continues to be a nice growth driver for subscriber growth as well. So when you put those two things together, Netflix clearly showed that the growth path ahead was much higher than we were first expecting.
And at the same time, we learned about sort of engagement in terms of hours spent on Netflix, which actually went down. Is that a negative? And if so, how big a negative?
Yeah, so the engagement growth did actually grow in the second half, but on a per subscriber basis, given how strong the subscriber growth was, it did tick down, but actually improved in the second half versus the first half. So in terms of the overall momentum there, what we found, and taking a step back here, Netflix continues to be the dominant force in terms of streaming engagement. When compared to all the other SVOD platforms, they do trail YouTube, according to Nielsen in the US. But on a global basis, Netflix is very much the dominant streaming platform. And they have a lot of opportunities to monetize that. As I mentioned on the ad tier, that's one way that they have been monetizing this engagement differently. And the other way, when you start looking about the massive engagement that they do have on a per hour basis in terms of the monetization there's an opportunity because the company is viewed much more importantly than a lot of the other streaming platforms out there.
And Robert, what about live events as well? I want to get your take, because 2024, that was a big year for Netflix. You know, Jake Paul, Mike Tyson, the NFL games. How do you see live events evolving from here for Netflix?
Yeah, I mean, they, again, have clearly went in the right direction here in terms of the strategy, clearly showing how successful and how much they can really dominate the culture with the live events that they had that you mentioned, introducing the NFL games on Christmas, having the Beyonce Bowl, all things that really kind of cut through the broader culture. So what I think Netflix has proven is this live event strategy is something that they're going to continue to lean into. They have introduced WWE as part of that ongoing live type programming. I think just announced that this past couple of days another women's boxing fight. So there's a lot more that will probably be coming here. The ultimate question is how much do they lean into sports in general? And that's one of the newer debates around Netflix moving forward.
Robert, all of this said, your tone sounds pretty positive, and your commentary sounds pretty positive. You do have a neutral rating on the stock, though, and an $850 price target. And I'm curious why, given that you do seem pretty optimistic.
Yeah, for us, I mean, valuation versus fundamentals is always the right question and the balance for us. We have been on the sidelines for Netflix, and the stock has completely outperformed our expectations. It obviously has pulled back recently, just given some of the broader macro backdrop that I think you guys were talking about earlier. So in terms of where to from Netflix, it comes down to how much the revenue is going to continue to grow. We're not going to get subscriber metrics going forward. So what that revenue monetization can be versus expectations. And they had a tremendous success in terms of the profitability growth last year. And how sustainable is that moving forward in terms of over the next few years? I'm not even just talking 2025. So when you bring all that together, that's where we have remained on the sidelines.
Thank you, Robert. Appreciate your time.
Thank you.
The Crypto Summit now getting underway at the White House. Let's listen in there.
Foundation of the new reserve. Unfortunately, in recent years, the U.S. government has foolishly sold tens of thousands of additional Bitcoin that were worth billions and billions of dollars had they not sold them, but they did sell them, mostly during the Biden administration. Not a good thing to have done. From this day on, America will follow the rule that every Bitcoin knows very well: never sell your Bitcoin. That's a little phrase that they have. I don't know if that's right or not. Who the hell knows, right? Who knows? Who knows? But so far, it's been right. And well, let's keep it that way. The Treasury and Commerce Departments will also explore new pathways to accumulate additional Bitcoin holdings for the reserve, provided it's done at no cost to the taxpayers. We don't want any cost to the taxpayers. In addition, my order directs federal agencies to conduct an inventory of all crypto assets currently held by the U.S. government and determine how they can be transferred easily to the Treasury. Non-Bitcoin digital assets will be held in a new U.S. digital asset stockpile where they will be managed properly. My administration also is working to end the federal bureaucracy's war on crypto, which was really going on pretty wildly during Biden until the election came about. About 5 months before the election, he became a big fan because he heard how many people were in favor of it and how many people love it and respect it. But I guess it didn't work out too well for him. People understood what was going on and paved the way for groundbreaking innovations in institutional finance. Under the Bitcoin administration, regulators strong-armed banks. I mean, they really did. They strong-armed banks into closing the accounts of crypto businesses and entrepreneurs, effectively blocking some money transfers to and from exchanges, and they weaponized government against the entire industry. But I know that feeling also. Maybe better than you do. All of that will soon be over, and we are ending Operation Choke Point 2.0. Now, some people really suffered. It was ridiculous what they were doing. But in the end, they came around, but they came around for the wrong reasons. They came around only because they wanted votes, and they saw that tens of millions of people were against them because of what they were doing. I also want to express my strong support for the efforts of lawmakers in Congress as they work on bills to provide regulatory certainty for dollar-backed stablecoins and the digital assets market. They're working very hard on that. This is a tremendous opportunity for economic growth and innovation in our financial sector, and will really go a long way. I think it's going to be a tremendous, we feel like pioneers in a way, of tremendous method of growth. And things are very much tied, and we want to keep it that way, the U.S. dollar. Long into the future, we're going to keep it that way. I hope lawmakers will send that legislation to my desk before August recess if they can. And they're very much working with you, and you know a lot of them, and a lot of them were committed right from the very beginning. So I just want to congratulate you all for being at the White House today, and a man who knows more about Bitcoin and AI and just about everything else than anybody, David Sachs. And I'd like to have you say a few words, David.
Thank you, Mr. President. We're all here today because of your leadership, your vision, and your generosity, and I really want to thank you for that. We're also here because of your desire to make America
We've been
great
watching
and
President
to
Trump
introduce
during his crypto summit that he's been holding at the White House with a number of different executives from the industry, as well as his crypto and AI czar, David Sachs. And Trump just talking there about this Bitcoin reserve that he would like to create. He just signed an executive order this week in order to create that. He kind of joked around and said, they say Bitcoin is always going to go up. I don't know. Which, it's fair.
It's volatile.
It is a volatile asset, to be sure. But we'll continue to monitor that to see if there are any other headlines that are material to the crypto industry. Obviously, the vibe, if nothing else, of this administration has been much more crypto-friendly. And more than the vibe, we're seeing, for example, some of the regulations that we're seen as being a constraint on the industry are slowly being removed.
And we were talking earlier, too, Julie. It didn't seem like investors were particularly, wowed by the Bitcoin reserve news, and maybe as we were chatting before, maybe that's in part because some investors had kind of been hoping, well, you weren't just going to give me a reserve, you were going to talk about buying tokens. Although it was interesting, David Sachs, I did see our crypto czar, of course. I did see him kind of suggest there could be a buying plan if they could figure out a way to do it sort of under budget neutral conditions. So we'll see.
We will see. And we are wrapping up today's Market Domination. But don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.